Today's video is on the very important topic returns investors should expect. It is a topic which is at the center of many investors' concerns, and we will provide you with a practical perspective on this important topic. When markets are doing well, investors start expecting very high double digit and even triple digit returns every year, right from traders touting 50% returns every month to new investors with a formula that can 10x your money every year. Bull markets lead to their own bull stories. They forget that even the greatest investor of all time, Warren Buffett, has only generated 23% returns a year. The truth is that your returns are likely to be more pedestrian. There are a few reasons for this. The past decade has generated unusually high returns for investors. Also, the valuation levels at which we are starting doesn't give us reason to expect very high returns from here. So, for instance, stories of 50% returns a month means that an investor can turn 1 lakh rupees into 28 lakh crore in just 4 years and become the richest person in the world. This video explains why investors are unlikely to earn the same high returns that they have in the past using the traditional portfolio. It presents investors with an alternate portfolio which can continue to generate high returns. Hi, this is Prashant Saraf, and you are on my channel Blueprint Investments. I am on a mission to arm 1 lakh investors with the knowledge, strategies, skills, and tools to create life-changing wealth for themselves and their family. In other words, even if you have achieved a one-off doubling of your money in the last 6 months, it doesn't mean that you can do so every year. In fact, the number of people that can grow their money at rates over 20% for 20 years or more can be counted on the fingertips of one's hands. In other words, if the world's best investors like Warren Buffett and Stanley Druckenmiller can only generate returns in the 20s, ordinary investors are likely to earn much less. How much less? A good way to look at this is by looking at the returns that the Sensex or Nifty have generated over the last 30 years. These returns, while solidly double digit, are about half those of the top investor, approximately 12 to 14%. After you reduce expenses and turnover costs, the average investor would be reasonably happy with 12%. As most investors are not 100% invested in the stock markets, these returns will change based on the performance of the other investments. While stocks have been the best performing investments over the last decade, this need not always be so. The takeaway from all this is due to technology and other advances, people assume that returns are permanently higher, but most likely they are not. 3 reasons returns have been good. Reason 1. Low interest rates keep funding costs low and inflate stock multiples. This can be seen as stocks have risen higher than what the company's earnings have. While stocks have risen by 15% a year on average, companies' earnings have only risen by 9% over the last 20 years. The other reason is that the macro and geopolitical environment has been very stable. Since stocks price in risk, they have been pricing in lower risks, and so they have revalued higher. The most important reason, however, is that the quality of companies have improved. As investors get more informed and information is easily disseminated, shady promoters and companies are going out of business. Out of the 3 reasons discussed, the first 2 are going to change, and so stocks should revalue lower. So, a carefully constructed portfolio of stocks and alternatives might only yield 9% in the years to come. To mitigate against this, investors should invest part of their money in investments that will benefit as these tailwinds turn to headwinds. 2 examples of such opportunities are buying stocks in sections of the market which are undervalued and buying stocks of commodity producers who will benefit as inflation rises. Investors really need to worry about the impact of these changes on their investment corpus. To do this, investors need to assess the corpus they can achieve with 9 to 10% returns over their investing horizon, say 30 years. We have constructed this table showing how investment returns moving from 12% to 9% can impact investors. The impact, instead of generating 30 times the initial investment, investors generate only 13 times their initial investment.
If investors would like to increase returns, they would need to follow strategies that have proven to generate superior returns to that of the market over long periods. A few of these strategies are long-term compounders. These are high-quality businesses with excellent management that are available at fair prices. In investing parlance, such durable competitive advantages are called moats. Moats can be of many types. The low-cost moat, where the company has the lowest cost of production in its industry. The distribution moat, where the company has the widest and deepest relationship with its distributors. The brand name moat is the most durable, where the brands like Coca-Cola and Parle-G are synonymous with their category. Growth at reasonable price strategy. Buying companies which are growing sales and profits at a fast clip while still being valued reasonably. The first rule of the strategy is to invest in the cheapest quartile of major international stock markets based on the PE ratio. As an additional filter, this strategy would not invest in the countries where the currency is on a weakening trajectory or where inflation is strengthening. Dividend growth strategy. This strategy entails investing in cash generating stocks with growing dividends. Alternatively, they can use strategies that suit the current macro context of commodity shortages and high inflation to invest in commodities and real estate. A few commodities that are expected to do well are copper, oil, natural gas, fertilizers, as well as precious metals. Copper demand is expected to be high, driven by demand for renewable electricity, while supply is constrained, boosting the prospects of returns in copper mining stocks. While consensus opinion believes that global oil demand has peaked, an increasing number of people, however, are crossing an important milestone in per capita income, accelerating the global demand for oil. Natural gas is the cleanest hydrocarbon, and an increasing percentage of the global heating demand is expected to be powered by this natural resource. Agricultural markets like wheat, corn, and soya bean, along with fertilizers, are likely to be in deficit for the coming decades as the developing world starts consuming a heavier protein diet. Gold and precious metals have never been cheaper compared to the amount of money printed. Using these strategies, investors can hope to earn 15% annually, about in line with the returns of the last 10 years. As compared to an investor who earns 10% using the traditional asset classes of equity and debt, this is quite a lot more.
In fact, over 30 years, the corpus created can be 66 times more than the amount invested using these strategies. This compares favorably with 13 times the invested amount using the more traditional portfolio. To assess the impact of these changes, let's take an example of two investors. Investor 1 earned 9% per year for 30 years, while Investor 2 earned 15% per year for the same 30 years. Would you like to know what was the difference in the investment corpus of the two investors? Well, Investor 1 grew his initial investment of 10 lakhs to 1.3 crores, a growth of 13 times, while Investor 2 grew his corpus to over 6.6 crores, a growth of over 66 times. Coming back to the chart, we can see Warren Buffett's multiple of 3 crore times. This has been achieved by generating 23% returns per year for over 80 years.
While these type of returns are not something that ordinary investors can aspire to, they can definitely follow many time-tested strategies and generate better returns going forward.
With that, we come to the end of our video on investor returns.